Hello there, folks. Welcome into today's video. We got two to react to. It's a buy one, get one free here today. Chart Master on what's next for the markets. We'll hear what his opinion is. I'll kind of share my perspective on kind of where the markets are headed next as well. And then we're going to react to this one. Expect stocks to struggle amid surging rates from David Rosenberg. So we'll hear what he has to say, and I'll react to that one. Let me first off say, I like kind of the cautiousness on the market still at this point in time, right? Obviously, off of those October lows that we hit, right? We've been on an upwards trend. Let's just put it that way, right? And we've had pullbacks for a few days, a few weeks, things like that. But ultimately, we have just kind of been on an uptrend, right, for months now. And so I like how much cautiousness there has been as this market has kind of rolled higher and higher and higher as time has gone on here, right? And a lot of stocks have gone up 50%, 100%, 150%. And yet still, like, people aren't on this bullish bandwagon. And I take you back to a market back in the 80s, and I was going through some of this on the main channel in a video recently on how there was a bull market in the early 80s, and it was arguably, or certainly one of the most hated bull markets we went into. Then we had another bull market, I think it was around 1990, and the Dow, I believe, hit 3,000 for the first time, and it was such a hated market. No one believed in the rally. No one believed it was real. Everybody thought we were going to crash back down and those sorts of things. And so, you can get into these sorts of markets that are just like, it kind of ends up rolling higher and higher. You have some pullbacks here and there, but it just rolls higher and higher, and people are like, it has to crash. It has to go down, and there's just so much pessimism out there, right? And yet the market just kind of rolls on and does its own thing, and then time evaporates some of the bearish problems and those sorts of things. So you can have those sorts of markets. So I just appreciate that we're still in kind of this bearish sentiment around the market, while ultimately we've kind of been rolling up and up and up. So anyways, guys, appreciate everybody joining me as always. 24,100 plus subscribers now on this channel. I appreciate each and every one of you. Also, I appreciate every single person that supports the channel on Patreon. That's the pinned comment down there if you want to support the channel on Patreon. And you also get to see all the stocks I'm buying and selling in the Patreon portfolio in there with screenshots every single week. That is pinned comment down there. Let's get into this.
Let's bring in the chart master, Carter Worth. Carter, S&P 500. I told you before that I had to look up pair of twos definition. I'm glad I did, because you're using it again.
Yeah, the thing is, sometimes it's just, a malaise. It's stuck. It's spinning its tires. It being a stock, a currency, a commodity, an index. The market is basically going nowhere. And in many senses, that's why the pair of twos designation exists. Big hands are big, and we know in life when you have a big opportunity, you go for it. This is not three of a kind. It is not a flush. It is not a straight. It is almost five random cards. My bias remains the downside, and I think ultimately that on an intermediate basis, there's little to no upside, and unknown but prospectively meaningful downside. And every time we have these big counter trend moves, the bullish sentiment pops, and it seems to be dashed repeatedly. So you see the chart here, converging trend lines. It's even money, fair money. Again, my bias is the downside. But let's take a longer term iteration. That's a year chart. That's 5 years. Again, it's, if you didn't know what it was, that's the thing, and someone showed you this chart.
There was flying these choppers over my house. It's like I'm in a flipping flapjack in war zone over here, man. It's like, you should see the size of these choppers they fly over my house. I'm like, dude, can you guys chill on all that? Like, fly your freaking chopper somewhere else. It's ridiculous. I don't know if they're going out to Red Rock to show people, I don't know, in a chopper what Red Rock looks like. I'm like, calm down with the chopper stuff, okay? No, first off, in regards to this gentleman, okay, I wish a lot of these guys were more specific on time frames, right? And when he talks about little upside, bigger downside, those sorts of things like he was just talking about, I believe what he's referring to is really in the short term here. I do not believe he's talking about the next 6 months. I don't believe he's talking about the next 6 years. I believe he's talking about likely the next 6 weeks, okay? And so that's very important to kind of keep in mind in regards to some of these people and their calls and those sorts of things, right? A guy like this, looking at the technicals, he's thinking very short term. He's thinking likely over the next few weeks, okay? That's what he's referring to when he's talking about there's a little upside over the next few weeks. And I got to say, I kind of agree with it a little bit at least, because, we're kind of through earnings season now at this point in time, right? It's still a month and a half to 2 months before the next earnings season hits. So this earnings season is pretty much done other than small cap stocks, but we know small cap stocks don't move the market. All the big dogs have done it now at this point in time. So You don't really have anything to move the market up in any substantial way in the short term unless we had inflation numbers come in really low or something like that. That would be a game changer because then it would have just showed like, oh, that one bad inflationary month we had there was just one bad month and the ultimate trend is much, much lower, right? So outside of that scenario, I can't really see anything necessarily boom in the market right now in the short term, okay? At the same time, you don't really have anything to go off of to really push the market down in any substantial way, other than maybe some technical data, but you also have some positive technical data out there. And, if we had another bad inflationary reports that come out in the month of March, then we could be talking about a bigger downward move if you had more hot inflation numbers come out. But outside of that, I mean, you don't have a lot to move off of either way here, so I do kind of agree with him.
A pictorial representation of price. What about that would make you run out and buy it? Or, frankly, let's sell all of it, short it. It's just sort of equilibrium. Now, does that mean it's going to stay here? Of course not. People think it's going up in a big way. This chart is important. It's the long-term chart, picking up the financial crisis peak, the 09 low. And we have ascended within this perfect 45-degree channel since the 09 low until we went out through the top in late 21, early 22. And valuations at that point, because fundamentals and charts match up, were at or near records. And now we're sitting at the midpoint of the channel. Again, just even Steven. A pair of twos, but I do think we have more risk of going to the bottom half of the channel than back to the top.
What is the bottom half of the channel, just for reference, Carter?
Well, it's how quickly you get there, right? Because it's moving. So if you go there tomorrow, it's sub 3,000. If you get there towards the middle of the year, end of the year, it's more like 3,500.
Okay. Either way, that's a lot. Carter, thank you.
You bet.
Carter Braxton Worth.
So as a long-term investor, I hope that happens. Send it there, baby. I'm doubtful, but let's send it there. That would be a lot of stocks for insane discounts. There would be growth stocks all over the place, great deals. Value stocks, a lot of the growth stocks would not go back down to their previous lows, though, even in a scenario where the S&P goes to, let's say 3K to 3,300, something like that. Netflix isn't hitting a new low. Meta's not hitting a new low. Shopify's not hitting a new low. Tesla's not hitting a new low. Even in a scenario like that, you wouldn't get a lot of those stocks to hit new lows, which I wish that would happen, but you wouldn't get that. You would get a lot of pain in a lot of the value plays, a lot of the dividend plays, more pain there, a lot of the Dow stocks. Some of those you would get more pain, which would just be a great steal, because then is GVD 1, 2, 3, right? My strategy, growth, value, dividends, that'd be beautiful.
We all, that chart is pretty scary if you look at the bottom side, and I think it's around 2,800 is the bottom of that channel. And as Carter said, so it's 2,800 to about 3,300. But what's impressive about this market is that we were holding the 200-day. We tapped it again today, almost down to the penny. So as long as we can keep testing the 200 and stay above, that's your barometer. Unfortunately, there's a couple of tests that are going on it. I think we're going to wind up playing with the same 150, 200 handles in the S&P until we have closure.
Yeah, and you're not going to get closure until you get either earnings to dump, earnings to pick up, or inflation data to continue to show a major downtrend over the next several months, and which would give confidence that the Fed will pause rate hikes and actually potentially even start cutting if inflation continues to come down, and next thing you know, starts getting into the 4s, 3s, and then ultimately the 2s, which is where the Fed wants it when it comes to at least CPI data, okay? But that's what will really be able to tell you where the market's going from there, okay? Next video up here, expect stocks to struggle amid surging rates. We'll hear what they have to say here, and I'll kind of share my perspective.
Rosenberg, founder and president of Rosenberg Research. David, great to have you with us. And I wanted to ask you about, a part of the conversation we were just having, and that is what the HYG and the JNK is telling us. And I'm wondering if you see glass half full or glass half empty here, because the chart really says that maybe there's not too much going too badly. And I'm wondering, when you think about this lagged effect of rate hikes, when does that start hitting this part of the credit market? Because you would think that it would start hitting now.
Well, I think that when you're taking a look at the leading indicators, and we just got the money supply numbers today, and M2 is down a record 1.7% year over year. That's a leading indicator. I heard you guys talking about the yield curve. Another ironclad leading indicator, there's the Fed Loan Officer Survey, which has tightened dramatically in the last quarter across all types of bank credit. These are all leading indicators. It's a matter of timing. I think that right now you've got a situation where the stock markets and the credit markets seem to think that they have more time that they can buy before the boom really gets lowered on the economy. There's no doubt the economy is not strong, but it hasn't weakened precipitously. But the one thing we have to keep in mind is, whether it's money.
So, I got to tell you guys, okay? I got to tell you what happened last night, okay? Last night, a little late afternoon / last night, I went to the Wynn and Encore, okay? I don't know if I've ever seen the Wynn and Encore that busy. I mean, they must be at full capacity down there. This isn't even a big sporting weekend. Like, the only thing I could even think about that was going on on the Strip was, like, the John Jones UFC fight. Outside of that, there was, like, nothing even going on, right? And that place was just insanity. Like, I had trouble even finding anywhere to park. I had to go park at the Encore because the Wynn, I couldn't even find parking at the Wynn. So I had to park way at the backside of the Encore. And it was just it was a zoo in there. It was extremely, extremely busy, like among the busiest I've ever seen it. They must be at full capacity. And so, it's one of those things I look at. I always like to kind of keep an eye on what's going on in the Strip. Is it less busy than usual? Is it more busy? And I hadn't been down the Strip in a while, and I was just like, I was blown away. I was just like, usually I don't have trouble finding a parking spot at the Wynn. And, the fact that I was whipping around the garages and I had to go park at Encore is just, and as I was walking around, I was just like, everywhere was busy in there, man. Very, very busy. So, I don't know. Of course, Wynn and Encore, they do have higher-end clientele, so do keep in mind. And obviously, if you're talking about inflation, it's hurt lower-income consumers the worse. That's very, very obvious when it comes to that, right? But, gosh, I keep looking for like these signs of like, oh man, everything's got to be devastated. And then I go out and I'm like, oh my gosh, it's freaking busy. I went to Fashion Show Mall. I went to Nordstrom, busy. I went to Foot Locker, stock I own. I also own Nordstrom as well, busy. And kind of like, okay, the mall, everybody walking around with bags. Here we are in March, and everybody keeps predicting recession. Everybody's going to run out of money, right? And it's like the world just keeps spinning. So I don't know, man. That's a tough thing out there. You go to the real world, and it's just like, okay.
The LEI, the yield curve, all these other things that we have in the crystal ball. It's telling me that the recession probably starts Q2 no later than Q3. And the time horizon for the markets, whether it's credit or equities, is shortened up so much that it's only when they see the whites of the eyes. And I think a lot of it will have to do as well with employment. Employment has to start contracting. Once employment starts contracting, and of course that's the bellwether coincident indicator, I think that's where you're going to find the risk on trade, really coming under downward pressure. Reality is that we're not there yet. But give it, I'd say, 3 or 4 months, and we're going to have a different economic picture on our hands.
So you think it's that long out? So I guess my question to you is, Dan talked about...
It's definitely a possibility, right? It's just we keep pushing the can down the road. We're like, oh, the recession's coming in 3 or 4 months, and 3 or 4 months. And it's like we've been pushing this can, and we've been pushing it. It's like eventually we'll have one, right? And by the way, I still feel like we had one in 2022. They just didn't call it that, the government, for whatever reason. And I think that adds to the more of the problem with the fact that they didn't call it a recession. Now everybody's still expecting a recession and pushing the can down the road. And so who knows, maybe in 3 or 4 months we're still not there, and then they'll be talking about 3 or 4 months. It's coming. Just get ready. It's coming. And it's like I said, at the end of the day, it's good that everybody has this built-up fear of it because it does ultimately help decrease demand out there. That's just the bottom line, because if everybody's concerned about this, it's coming, right? They're are just going to be a little tighter as far as their pockets go, which is something that obviously will help inflation come down.
Case here, but all we've seen, and Jeff Mills speaks to this, really multiple expansion. Why are we seeing multiple expansion in an environment where people should be paying less for earnings, not more?
Okay, I'll answer that before this gentleman. I want to hear what he has to say here. The reason is, at the end of the day, if you look at many of the biggest companies in the world, they're going to see their earnings in net income increase this year. Quite substantially. Meta's net income is going to be substantially more than it was last year. Amazon's net income is going to be substantially more in 2023 than 2022. Apple, the jury's still out. Microsoft, likely that their net income is substantially higher in 23 than it was in 22. Tesla, jury's still out, but there's definitely a potential. They cut price, so that's going to hurt margins a little bit, but then if you get a volume tick up there, we'll see what happens with Tesla, but it's definitely a potential. So you start going through a lot of the biggest companies in the world, and you're like, oh my gosh, their net incomes and their EPS is actually going to climb, and some of them is going to climb substantially. So if that's the situation, then you have to be willing to pay more for those companies if their net income and their EPS is going up substantially, right? That's the trouble in the market right now. That's if you're talking about from the bear side, is it's like you're really going to bet against the market, bet against these stocks when a lot of them are going to have much better net incomes and EPS in 2023 than they did in 2022, because a lot of these companies had huge one-time expenses. They had big layoffs of employees, which are huge one-time expenses that they had hit. They had a lot of investments in different companies that hit their net income, where basically those companies didn't pan out. Stock prices went down, valuations came down, right? That ultimately hit their net income on a GAAP basis, because that's the way they have to run GAAP numbers nowadays. Like I said, I don't agree with it, but it is what it is. And so you look at all those different various factors there, and it's like, well, in an environment where you're expecting companies to have net income and EPS go up quite dramatically as the year goes along, what are you going to do in that situation? And if you just keep pushing down the recession of, it's just 3 or 4 months, eventually the market's going to start to not have a belief that it's coming. Eventually, okay? We're not at that stage yet, but I'm telling you, if they just keep kicking the can down the road in this and you don't see it, eventually everybody's going to disbelieve it. By the way, that will be that big secret. That will be when it happens, okay? When no one believes in it anymore and they're like, we're sick of this, okay? And who knows, maybe that happens at the end of this year or next year, something like that. That will be the moment that it actually happens, when everybody's given up on the idea and they're like, everything's great now. And then all of a sudden you'll get the recession. So that'll be the time to short to the moon at that particular time.
I totally agree with you on that. But, we're talking here just, very short-term divergences. The stock market can operate, on its own dynamics, whether it's, fund flows or momentum chasing. I think you're 100% right. There is actually no better.
Did you guys see that unemployment numbers there? Did you see that? I mean, that's kind of what you're dealing with. And obviously I was down on the strip yesterday, right? A lot of opportunities out there. Even, remember I was talking about flying the choppers earlier? They're hiring for helicopter pilots. So by the way, if you want to get a job at, I think it's called Maverick or something like that. Get a job there, fly the choppers, okay? And I'll tell you what, please don't fly them over my house. Fly those freaking choppers anywhere you want to fly them, but don't fly them over my house, okay? I'm sick of those things flying over my house.
On its own dynamics, whether it's, fund flows or momentum chasing. I think you're 100% right. There is actually no better correlation with the multiple than real interest rates. And we've seen the real 10-year yield jump almost 50 basis points just over the past month. And it's got a very tight link with the PE multiple. In fact, when you map it out historically, the multiple actually should be much closer to 15, 16 than, say, 18. And then you got to slap on, if you have a recession view, which I do. I don't think we get out of this without a recession. It's just a matter of, what the timing is. I was talking about a recession throughout all of 2007. It didn't come until December that year, but it was still staring us in the face. And remember that the stock market saw it late. The stock market peaked just a couple of months ahead of the actual downturn. But I think that you're quite right. The multiple is inflated. I believe in Bob Farrell's rule number 1 on mean reversion. The multiple will mean revert, and it will do so against the backdrop of this very aggressive Fed, which has lifted both the term premium and at the same time the real rate. It's interesting that not much of this move in nominal bond yields has really been inflation expectations, despite the fact all of a sudden inflation is all the rage. It's really been the real rate, and that is not good news for the multiple. So I would just say give it time. We could be talking about something totally different, 4 weeks from now in terms of where that multiple is. Should be 15, 16, not 18. And then, we're talking about a recession, but, none of your viewers who are investors are buying GDP. They're buying earnings. And so where's Q4 earnings right now? Q4 earnings, the run rate is minus 4.7%. Last time I looked, Q1 is like negative 5.8. So the earnings recession has actually already started. And I think that would...
Yes, but it's very possible that Q4, Q1 are kind of the trough for earnings for a lot of these companies. And if you hear what the executives of these companies are talking about, it's very, very possible that Q4 is the trough or Q1's the trough. So, we don't know for sure. No one knows for sure, right? But that's something you have to consider in this market.
The question is, what's the stock market not seeing when you're seeing declining earnings, not slowing earnings, and declining earnings estimates? So maybe it's still about liquidity or it's about technicals. Today was nothing more than bouncing sharply off the 200-day moving average. So sometimes, look, there's nothing fundamental about it. And maybe sometimes it's not just about valuations. It's about technicals. And I think today was more of a very powerful technical move with the 200-day moving average, holding in. What's going to happen a week from now? Does anybody really know? I think that'll be violated. But that was the story today.
David, great to speak with you. Thank you.
Thank you.
David Rosenberg Research. David has a great Twitter feed. If you don't follow him. But he tweeted this chart out of S&P 500 earnings yield and the yield on the 6-month T-bill. And they're practically the same. So in this environment, what would you rather, right?
Well, see, and that's the thing. Treasuries have gone up so much. So many people are stuffing money in treasuries, right? Hurts the stock market short term, right? But what happens when eventually treasuries aren't yielding as much? Oh, where do you think that money's going to come back to? What happens when savings accounts, CD accounts, all those things are not giving you as much bang for your buck? Let's say in 6 months from now or a year from now, if the Fed's cutting, well, suddenly that money needs to move somewhere. Where do you think it's going to move? Straight into the stock market.
Unless you'd rather take a shot on the market, but for me, it's the T-bill for some amount, yeah.
Yeah.
And one thing he said, though, just made me think when he said, reversion to the mean, it doesn't go back to the mean. It goes beyond the mean.
Right, exactly.
And then
to get
comes
to the
back.
mean.
Yeah.
Yeah. Sometimes people don't do the math on that, as they call it. Jeff, what do you make of Rosenberg's thoughts?
Well, I agree with him, and he mentioned earnings, and I think that that's sort of critically important here. And we keep talking about the lagged impact of interest rates on the economy. One of the things with the highest correlation that we track is earnings and ISM manufacturing PMI. If you look at the lagged impact of earnings on manufacturing PMI, it's actually about 12 to 18 months, and that correlation is very tight going back decades and decades. So our point of view is that really that view or that move in earnings, that move in rates is only just starting to hit manufacturing PMI. That's going to continue lower. That's going to drag earnings lower. I think that's the key to all this right now.
Yeah, I'd say the one thing we haven't talked about is sentiment right here. And, again, at the October lows, I think sentiment was universally bad among strategists and among investors, among pundits, that sort of thing. And, right now it's kind of interesting. We had that huge rally, 18% off the lows. When I listen to David, and I've been listening to David for 20 years, and I just think he is one of the masters at picking apart what is often on Wall Street a universal bullish sort of stance. But right now, it's the exact opposite. Like, all the other strategists have come into his zone right now. And that does make me a little nervous. It's really hard to find a bullish strategist right now.
Isn't it so interesting? I mean, a lot of strategists have come in.
Exactly my point. Wow, one of the rare times I've ever agreed with this gentleman, Dan Nathan, right? This guy's like always bearish on almost everything, and especially Tesla. Man, he finds a way to talk crap about Tesla almost every single Fast Money episode. I'm like, how do you manage to talk crap about Tesla every single episode, man? It's actually rather impressive. But nonetheless, he's basically kind of making the same point I just made, just maybe slightly different, about just still be an overwhelming bearishness out there in the market. And, it kind of, if you are on the bearish side, that would be something that concerns me, is like seeing how little optimism there still is in the market. And yet you're having trouble really pushing down this market when you have so many people talking bearish, so much, pessimism, I guess you can say, out there. And yet you're not really seeing the moves you want to see if you're a bear. And it's kind of like, what's going on here? It's frustrating.
But if you really read them carefully, they've reduced their, S&P outlook to 4,000, 40, 50 or whatever. But the PE that they're still looking at is like 18 because they haven't lowered their earnings estimates a lot. So they really are fairly bullish, even within this wrapper of being more bearish, moving towards that bearish consensus.
Whether they realize it or not, right? And it's, again, why are you paying a historic market multiple in an environment where we haven't seen this literally in decades, right? Number one. And the other side of the equation is, as David mentioned, the earnings part is coming down as well. So it all becomes math. And listen, I'm not suggesting we're getting down to a 14 or 15, but even a 6. On the other side of the equation.
That's another thing that would scare the living crap out of me if I was a bear and I was betting short term on the market here, against the market, right? Because now, as far as earnings estimates for S&P, we're down to 222. Okay. Now there's very low expectations for the S&P 500. So now there's much more potential for upside for the S&P 500 than downside now for the S&P 500. Now that inflation's starting to calm down in a major way, you're hearing CEOs talk about that consistently out there. I mean, I've listened to probably, 20, 30, 40 conference calls this earnings season, and I hear almost every single CEO executive out there is talking about the inflationary situation has gotten better, not worse, better, and some are saying substantially better. And so now you're leaving this room for potential upside here. You know, this is where if you're a bear, you're in a bit of a pickle here. Let's just call it that. For a long like myself, right, and many of you guys out there, like it doesn't matter. Like we'll take advantage of deals, whatever we get. We don't really need the market to go up in the short term, but for these bears, they need the market to go down in the short term. And it's just like you're starting to have a lot of things start to slowly work against you, and that's going to be, I think, coming more and more over the next, let's call it 3, 6, 9 months here.
As David mentioned, the earnings part is coming down as well. So it all becomes math. And listen, I'm not suggesting we're getting down to a 14 or 15, but even a 16 multiple on $210, $220 of earnings is still significantly lower than we are now.
Yeah, that's fair. Appreciate you guys. Much love as always. Thanks for being here. Thanks for being subscribed. 24,100 plus subscribers. I appreciate y'all. Also, thank you every single person that supports the channel on Patreon. There'll be the pinned comment down there if you want to join us in there and get access to the stocks I'm buying and selling the Patreon portfolio. Much love and have a great day.